And for more analysis, we are joined by William Lee. He is Chief Economist at the Milken Institute, coming to us live from the sidelines of the Institute's Asia Summit in Singapore. William, good to have you with us. What do you think of Jay Powell setting the balance in his policy path?
It seems like Chair Powell has made it very clear that they are committed to lowering interest rates back to a more neutral position. Right now, the U.S. economy is doing quite well, and now they're satisfied also that inflation is well on its way toward 2%. That means that we need to lower interest rates down to where a neutral rate setting would be, and that's about 200 basis points away. But he also focused on the fact that they're going to do it gradually and look at the data and adjust the path accordingly.
Why do you think the Fed's interest rate dot plot evolved so quickly as it has in just a 3-month period from then?
Well, what's happened in the last 3 months, I think, has been very meaningful. They have enough evidence now that inflation really is on its way to 2%, but also they have a normalizing of the labor market. Now, there's a lot of talk in financial markets lately about the pending recession because the unemployment rate suddenly jumped from 3.5% to 4.25%. And I want to caution our audience to realize what is normal in the United States. A normal rate of unemployment is somewhere between 4 and 4.5%. A normal pace of job growth is somewhere on the order of 100 to 150,000. Right now, we've been experiencing well over 200,000 jobs being created per month, and the unemployment rate was well below its so-called natural rate, which is about 4 to 4.5%. It was at 3.5%. So right now, we have the right adjustments that show U.S. is on a steady course now. It's growing fairly strongly, and we have way too much restraint for an economy that is closing in on its cruising speed.
The U.S. business cycle does seem to be on the cusp of turning. I mean, credit card spending is strong. The widely watched gauge produced by the Atlanta Fed suggests GDP growing at an annualized rate of 2%. What's your reading of the U.S. economy?
Well, if there's any weak spot to be pointed out, and as a member of the dismal science, I'm obliged to point out where the downside risks are, and that's in consumption. Consumption has been very strong up until now. It's been growing something on the order of about 5% nominal, and wages have been growing only about 3.5%. So clearly, people have been outstripping their income. And what's interesting to note is that over 40% of consumption has been supported by only 20% of the population, because these are the people that have adequate savings to be able to dip into. You find that despite all the job growth we've had in the United States, a lot of the job growth has been in low-wage sectors. Hospitality, healthcare, and restaurants. These are places where people just have low wages so that they need a second and third job to make ends meet. So over half the population is living hand to mouth. And the other half of the population that have adequate savings, adequate wealth in terms of stock market wealth, those are the ones that are able to dip into their savings and actually do the spending.
William, let's talk currencies. There are those hoping that the rate cut will actually weaken the robust dollar, in turn lifting their own currencies. They may be disappointed. Will the dollar continue to hold appeal among non-US investors, do you think?
Well, over the long term, the thing that really determines the attractiveness of currency is the attractiveness of the country as a place for investment. And what you find is that in the United States, it is probably the most attractive place on earth for innovative investments that really will pay off in the longer term. AI and productivity improving types of investments are very plentiful in the United States as opposed to Europe and other parts of the world. So that is what allows investors to really want to come into the United States, and that's what keeping the dollar strong.
Okay, turning to the Asia-Pacific region, the U.S.-China tech war, the U.S. trying to keep high-tech away from China's military hands. Lots of economies in the region are actually vying to replace China as a supply chain. Who do you think are the biggest beneficiaries?
I just came from a conference in Korea, and Korea is an interesting country within ASEAN because it trades both with China and the United States. China is its largest trading partner. The United States is the second largest trading partner. And they were telling me that the tensions between the U.S. and China is essentially an opportunity for them to make bilateral deals as opposed to multilateral trade deals. And the difference is a bilateral deal allows two countries to customize the trade deal to the needs of the country so that you can help the sectors in which you are very strong and really shift resources toward those sectors. So a bilateral deal with the U.S. and Korea, and between China and Korea, will be a beneficiary to both parties. So even though the U.S.-China tensions are high, Korea and countries like Singapore that have these bilateral trade deals with the United States are really able to be quite nimble and handle the situation. The opposite case is a multilateral trade deal of the sort that, say, the Biden administration has been advocating. There, you want a bunch of countries to all agree together. And it's very hard to get everybody to agree to the same thing. And those take almost forever to negotiate. So I've been hearing, at least in Korea, that they are looking forward to more bilateral trade deals that can be revised as needed.
Okay, we shall be looking out for those bilateral deals. William Lee, thank you for sharing those insights. He is Chief Economist at the Milken Institute.